Good morning, everyone. I'm going to ask Mr. Melchers to read the docket.
Thank you, Mr. Chairman. Commissioners, we are here pursuant to notice of request for allowable ex parte briefing. The request was filed by Timothy Allen Simpson, Esquire, TAS Strategies, on behalf of Loop Capital Markets, Drextel Hamilton, the Williams Capital Group, Ramirez and Company. And it was set for notice today here in the Commission hearing room at 10 a.m. And we are ready to proceed. Thank you, Mr. Chairman.
Thank you. And let's just note that it's Timothy Allen Simon.
But, sorry.
Simpson.
Also, one other thing, our subject matter to be discussed today is South Carolina utility supplier diversity in financial services. Thank you, Mr. Chairman.
All right, Mr. Simon. Okay. Well, hang on one second. I haven't done this like in a week, so I need to recognize Ms. Pittman from the ORS first. Thanks, Ms. Pittman. Sorry to ignore you. I really wasn't. Okay, let's go ahead and get your ORS talk.
Thank you, Mr. Chairman. My name is Jenny Pittman. I'm a staff attorney for the South Carolina Office of Regulatory Staff, and I'm here today as the designee of the Executive Director of the ORS at this allowable ex parte. As the ORS representative, it is my duty to certify the record of this proceeding to the Chief Clerk of the Public Service Commission within the next 72 hours and verify that this briefing was conducted in compliance with the provisions of SC Code Section 58.3.260C. And the requirements of that statute are, in part, that the allowable ex parte be combined to the subject matter which has been noticed, and in this case, the subject matter is South Carolina utility supplier diversity in financial services. I therefore ask that the presenters, commissioners, and staff all please refrain from discussing any matters not related to this specific topic. Secondly, the statute prohibits any participants, commissioners, or commission staff from requesting or giving any commitment, predetermination, or prediction regarding any action by any commissioner as to any ultimate or penultimate issue which either is or is likely to come before the commission. Third, I would ask that the participants, commissioners, and staff refrain from referencing any reports, articles, statutes, or documents of any kind that are not included in today's presentation. A copy of any document which is referenced during the briefing today must be provided to me for inclusion in the record, which I will certify to Ms. Boyd. And finally, in addition to signing in on the sign-in sheet when you came in, everyone in attendance today must read, sign, and return the form, which is also on that same table. This form must be signed by each attendee to certify that requirements contained in Section 58.3.260C have been complied with at this presentation today, and you can just leave that signed form on that table with the ladies in the back. Thank you all for your time and attention. Thank you, Mr. Chairman.
Thank you, Ms. Pittman. Okay, Mr. Simon, we'll turn it over to you. And just let me remind everybody, especially if we've got a large group on the panel, that everybody needs to talk at one time. I mean, separately, not everybody at once, so that Ms. Wheat can get everything on the record. Thank you.
Good morning, Chairman Randall and fellow commissioners. Thank you. My name is Timothy Allen Simon. If it is okay with the chair, I would like to ask my colleagues to join me at the table.
Absolutely.
Yes. That would be Jeremy Traska, Sidney Dillard, Ray O'Connor, and David Finkelstein. Each can introduce themselves for the record and the court reporter. You're at the very end, David. Yeah, you're right here. Jeremy, if you could introduce yourself and we'll go down your title.
I'll just remind everyone, when you speak, those microphones, you push that little button that says push, and a red light will come up around the top, and you'll be hot. Or you'll be live. I don't know about hot.
Oh, don't hold it. Okay. Good. Commissioner Randall and fellow commissioners, my name is Jeremy Traska. I'm the head of capital markets at Drexel Hamilton. Drexel Hamilton is a service-disabled, veteran-owned broker-dealer investment bank. In terms of our background, we have a full-service platform focused not just on utilities, but other sectors, including aerospace and defense, public finance, securitization, and beyond. In terms of our headcount, we're 52% military veteran, 30% service-disabled veteran, and we have a unique social mission that focuses on hiring and training service-disabled veterans for careers in the financial services industry.
Good morning, Commissioner Randall and fellow commissioners. My name is Sydney Dillard. I'm a partner and head of corporate investment banking at Loop Capital Markets in Chicago, Illinois is our headquarters. We are a full-service investment banking firm. We are predominantly African-American owned. We have over 200 employees on our platform, serving corporate clients, clients in municipal finance, sales and trading clients in fixed income and equity securities. We are delighted to be here with you this morning. Thank you for having us.
Good morning. Thank you very much for allowing us to participate in these conversations this morning. My name is Ray O'Connor. I'm a managing director at Ramirez and Company in New York. We're the largest and oldest Hispanic investment banking firm in the country. We are a full-service investment banking firm providing corporate finance, capital market, and sales and trading, and asset management activities and products to our clients. I'm responsible for covering and providing banking services to the regulated and unregulated electric, gas, and water industries around the country. And it is an honor to be here today. Thank you.
This one doesn't, is it on? Doesn't have a red light. Okay, thank you. My name is David Finkelstein. I'm with the Williams Capital Group. Chairman Randall and fellow commissioners, thank you for giving us the opportunity to speak to you today. The Williams Capital Group was founded 25 years ago next month, so we're celebrating a very proud anniversary, and we have provided financing and served in financings for over 80 utilities across the country, utilities, holding companies, et cetera, affiliated issuers, whether that be unsecured corporate bonds or rate reduction and utility securitization. So we look forward to sharing our thoughts with you today. Thank you.
And in case Mr. Finkelstein did not note it, Williams Capital is an African-American owned firm. And that's much a part of our dialogue today. This is, again, Timothy Allen Simon. Should we announce our names every time we're on the mic for purposes of? Okay, thank you for that clarification. Again, thank you. It's an honor to be here in Columbia, South Carolina before this distinguished and august body. As some of you know, I'm a former California Public Utilities Commissioner. I also had the honor of serving as chair of the Gas Committee for the National Association of Regulatory Utility Commissioners. But my biggest honor with NARUC, as we call it, is I served as the vice chair to Commissioner O'Neill Hamilton. And for that reason, I always referred to him as my chairman, and with great honor and distinction. Today, we're here to discuss the capital markets, both public and private, in relationship to the utility complex, and particularly here in South Carolina. Daily, utilities across the country go into the public markets and private markets by way of issuing either debt securities or other types of notes. Even though some commissions do not engage in policy, what all commissions have in common is that they approve the ability of a utility, an investor-owned utility, to go to market. And the purposes of our being here today is to raise the dialogue about the exceptional qualities of these best-of-breed firms that are represented here today and how their engagement with the investor-owned utilities that you regulate increases competition and brings a greater benefit to the ratepayers by way of that competition. As all introduced, we're here today with some of the best firms in the nation, that being Drexel Hamilton, Loop Capital, Ramirez and Company, and the Williams Capital Markets Group, or Williams Capital Group. And these firms are often actively involved in the ability of our utilities to engage in financing the infrastructure and operations and management of the companies that you regulate that have the obligation of providing reliability on demand to the ratepayers that of this great state. And we find that oftentimes the inclusion portion of diversity and inclusion requires that those who have the ability to make the decisions that engage this process are aware of the firms that are often can be overlooked because of the market dominance that our larger money center banks have. I have the honor of being the clicker this morning. I have the device, so I'm going to remind my colleagues here to let me know when we need to move to another page. But if we move to page 1 of our presentation, we will note the performance in the marketplace going back to 2010 and the number of transactions with minority firms. It's a positive story, but if we note between 2016 and 2017, we've seen somewhat of a decline in the marketplace in terms of the number of utilities that are utilizing diverse firms. We cannot quantify or verify or provide an evidentiary finding for the reasons, but we know that by engaging in what we're doing today, and by you allowing us to be a part of this allowable ex parte briefing, we raise awareness. And by raising awareness, we increase the probability that the firms represented here today and in the marketplace that are not here today can be engaged in this important aspect of our critical infrastructure for our utilities. With that being said, I think it's important to note that this nation is in need of greater infrastructure. As we know, our Congress and Senate and our executive branches have all spoken of the need for us. I know we've all traveled the world looking at different utility operations, and we've been able to see firsthand that America needs greater investment in its infrastructure, and I think this includes our energy infrastructure, be it our pipeline safety enhancement capabilities or smarting our grids, or bringing in distributed energy resources. So this all requires financing. And the ratepayers, and we'll show in some of the slides that you will see, the ratepayers are better served when you have a wider spectrum of entities that can come into this marketplace by way of the competition that that brings. So with that, I'll pass it over to my colleague here, Jeremy Traska, who is a veteran who served our country and represents one of the premier firms in our nation that is owned, run, and operated by service veterans, many of whom are disabled service veterans. Jeremy.
So the slide we're looking at, that's actually a transaction that Drexel Hamilton had the honor of participating in. This one was from June of 2016. For South Carolina Electric and Gas. Just a little bit of background. SCAN has been the only utility in state that you regulate that's used diverse managers, and I believe it's only been Drexel Hamilton. And I'd say the relationship with SCANA started in 2013. We had set up a meeting with the management team focused on finance, and I think sort of our social mission and our background kind of got us in the door, but as Commissioner Ramirez Simon had mentioned, the value proposition that firms like ours bring, that's sort of what we came in terms of presenting. One thing that's important that was mentioned, I think the bottom line is just getting the best cost of capital for the ratepayer and providing liquidity, which a lot of us, we do have partnerships with credit banks to some degree, but in many cases we don't. So the value proposition that we bring, it's widespread distribution, price discovery, bringing in unique investors into a transaction that may be willing to pay what's more commensurate with the risk profile of an issuer. And in some cases, when you have large institutional investors, they try to get a little bit more than maybe they should in terms of spread, and that obviously flows down to the ratepayer. So we'll act as a sounding board in terms of price discovery, price thoughts, working with smaller investors. And that's what we had pitched to SCANA. I think they were intrigued by that argument. We had to sort of prove ourselves. A second thing that we had offered was, along with these smaller investors that we had promised to bring into the transaction, investor outreach was something that we were focused on and presented. Clearly, with the project, there was a lot of misunderstandings that had been going on in the investor community, and I think SCANA, they were a little under-resourced in terms of investor relations, particularly on the fixed income side. So that's something that we tried to work on, and So I think that was a compelling enough argument for the management team to bring us into. There was a spring transaction in 2014. That was the first one that we were invited into, and I think we delivered. We brought in unique investors, who gave their thoughts on pricing that were maybe a bit stronger than I'd say in terms of the larger institutional investors and some of the managers. Or the book running banks, the big money center banks. So we, to a certain degree, acted as a sounding board, maybe to keep the bigger banks and the larger institutional investors in check to a certain degree. So that's kind of a role that what was a value add, among other things, to the transaction. So we were invited back in 2016. That's the slide that's on that we're currently showing. And the relationship's been good since then. One thing beyond, and this sort of leads into how some of my colleagues here, what distinguishes themselves versus other banks. I think the management team sort of, they looked at their rate, the rate paying base within the state and within SCANA's service territory, and I think the argument that you want suppliers, whether it's in financial services or other areas, to be more reflective of the ratepayer base. I think some of the larger banks don't have an understanding of that. Many are headquartered in New York. They come in with a lot of balance sheet credit to extend, but in terms of really understanding a certain state, I think we had a greater affinity. We had a better, because of our military veteran background and headcount. South Carolina is obviously has a high veteran headcount, and then beyond that, also, it's reflective among minorities and women as well. So that's sort of another thing that I think SCANA sort of bought into, as many utilities have had in the past. Another thing was our public finance effort. We had a strong relationship with State Treasury. We'd been doing business with them on the investment management side, and then also public finance. So we understood the state probably better than some of the large banks. I can throw out Goldman Sachs, J.P. Morgan. And I think there was just a high level of trust. As a veteran-owned firm, I think the dedication to the state and the country was something that maybe separated us to a certain degree versus the large banks as well. So that's the key. So I think some of the arguments that I laid out, particularly in terms of having suppliers in professional services and beyond being reflective of the ratepayer base and an understanding of a local area, municipality, estate is very important, and it's additive to the transaction beyond what I mentioned in terms of improving cost of capital and sort of acting as a sounding board versus larger managers and institutional investors.
Before we move to Sidney Dillard, if I could just say, Commissioners, please, even though we have Q&A at the end of the presentation, but if there's ever an occasion where you want to pose a question to any of the panelists, please feel free. And now, Sidney Dillard.
Mr. Chairman, if he could just for the record, tell us what the acronym it stands for. I don't see it in the materials.
Which
the MWDVE, and then later it's MWDVBE.
Yes, that is minority, women, and disabled veteran business enterprise. Yes, thank you.
Thank you. This is Sidney Dillard. I am going to address this slide where we wanted to provide the Commission with background in the context of Dominion, particular Dominion Energy, and their use and involvement with minority, women-owned, disabled veteran business enterprise firms, particularly in the context of the ruling last week with regard to the Dominion Energy SCANA transaction. We looked back to 2016, which was the first time that Dominion began to use minority firms in the context of their capital raising. And what they've done in that time from 2016 to year to date, 2018 is a total of about $13.6 billion, $13.7 billion in issuance. And of that, they have worked with minority firms in the context of 27% of the transactions and $3.9 billion of the par value of issuance that they've had in that time. 4 firms have been involved in those transactions, including my firm, which is Loop Capital Markets, Drexel Hamilton, Ramirez and Company, and CL King were among the firms that they have used. At the bottom of the slide, you will see a list of the various Dominion Energy entities and what the specific dollar amount was that they've issued in each year, and the number of transactions that represented. But we've been very encouraged by our ongoing discussions with Dominion and how it is that they're thinking about diversity and inclusion in the context of their capital raising activities, and expect to continue to grow the ways that we're able to work with them, and certainly excited to be able to do that.
In our next slide, we move to my home state of California, actually in the next few slides, and some examples of what we have been involved in California. California has, to a large extent, been a leader in the energy and utility sector in general in a number of areas, many of which are now becoming more commonplace throughout the nation, including the engagement in renewable energy resources and greater energy efficiency programs and other matters that have been largely environmental. But some things that California has not been noted for is its leadership and engagement in the area of supplier diversity in the financial services sector. The Public Utilities Commission in California was founded in 1911, and it was actually the Railroad Commission. And it took until 2010 before a offering or an issuance included diverse firms as lead managers and book runners in the transaction. And by lead manager and book runners, those are the ones who you will find often at the top of what's called a tombstone that reflects the transaction. And they actually run the transaction. And my colleagues here can provide more specifics because they're actually investment bankers and I'm a small town lawyer. But with that being said, California has taken pride in tapping into the extraordinary resources that are available in the minority, women, and service-disabled veteran professional services firms. So here on page 4, you will note that we have our major utilities in California listed, that being San Diego Gas and Electric and SoCal Gas, which are referred to as Sempra Utilities and Sempra Energy, and then Pacific Gas and Electric, as well as Southern California Edison. There are other smaller utilities in the state that actually have utilized diverse firms, one in particular, Southwest Gas, that is not listed. If you look at the bottom of the slide that's currently being shown, you can see the actual utilities themselves and the number of times they've gone to market and the amount of those specific offerings. As I've stated, literally daily, billions of dollars of transactions occur that involve our investor-owned utilities throughout the nation. However, the percentage of diverse firms that are engaged in that area clearly has a lot of room for what I'd like to call opportunity. It's not our place to out or either criticize firms that are not engaging with the diverse investment banks. It's our objective to see that as an opportunity to bring greater awareness. If we move to the next slide, page 5, we'll have other more recent examples of transactions that have occurred in California where some of the firms represented here today have been fully engaged. And when we were able to break that ceiling, for lack of a better term, in California, there clearly was resistance. Change can be challenging. And many of the large credit banks, as we refer to them, the money center banks, provide a multitude of services to the utilities that you regulate and that I had the honor of regulating. But all of the utilities came back stating how impressed they were, and in the case of when the ceiling was broken in 2010, our utilities in California received the lowest coupon rate in history. And that is reflected or impacts immediately the ratepayers because the ratepayers pay the principal and interest on the bonds or other issues that come out of the utilities. So it's important to state that while what you see here has a very strong social message in terms of social responsibility, the role of the economic regulator is to ensure that the ratepayer is receiving the best rate and the best use, what is just and reasonable in the marketplace. And I can assure you that these firms have achieved that threshold as well. Moving on to page 6 is simply more examples of these transactions going back to 2011. And we've had the chief financial officers from a number of these utilities that have spoken in California at what is called an en banc hearing. It's the General Order 156 en banc hearing. And I hope I'm not being offensive in referring to California because the utility regulation is a state function. The national function, as you know, is carried out by the Federal Energy Regulatory Commission and other bodies. But I think it's important to make that emphasis that in California, there's General Order 156, which was passed by the legislature in 1988. And what it created was an aspirational goal of 21.7% spend in all areas, with the exception of fuel procurement. Now, fuel procurement was not included because obviously that would run the numbers up very fast because of the generation obligations that the utilities have, either by way of their cell phone generation or their generation gained in the independent marketplace. But with that being said, this is not command and control. It's not a regulatory process that involves penalties. What it actually involves is points and incentives that the utilities receive when they engage a diverse contractor in a number of areas, even though today we're discussing specifically financial services. And with that said, I'll move to Ray O'Connor. I'm sorry, Jeremy Traska.
I think Ray and I are actually going to split the sort of discussion of this slide, but I thought I'd just kick it off. In this particular transaction, this was not a run-of-the-mill corporate bond underwriting. This was a rate reduction bond securitization that was brought to market to pay for the decommissioning of the Crystal River nuclear generation facility in Duke Energy Florida's in their service territory. In this particular transaction, we through our relationship with NARUC and more directly the Florida Public Service Commission, we were sort of recognized as a group of firms that had experience in prior transactions, so we understood the structure, which is not the case with some of the credit banks that Duke deals with, particularly some of the foreign banks. So in that case, we had more experience than some of the other key credit banks that they've been transacting with. In terms of the value proposition beyond just knowing these unique structures, which can be quite complex, the value proposition regarding investor outreach, investor education, and doing everything on the distribution side, to try to achieve the lowest cost of capital for the transaction. That was another thing that I think the PSC, the issuer, they had a good understanding of that. They had seen it in the past. So, they had put out an RFP to a number of banks, diverse banks as well as larger credit banks. And, I think three of the firms at this table participated in the transaction and sort of made the case. And, I think in the end, and I'm not sure if we're going to go through the specifics of the transaction. There's a lot of moving parts to it, but we played a strong role in, and it was a long process in terms of price discovery, optimizing the structure. I think there was, in terms of how many tranches, weighted average life, and beyond, that was sort of always in flux. So we had weekly pricing calls with the financial advisor, which was Sabre Partners. And the lead managers on the transactions, and it was a process that took some time, and I think in the end the best possible structure was reached, and we collectively did achieve a strong pricing across all four tranches that were brought. Not sure, Ray, if you wanted to add anything, if there's anything specific structurally, but I think the conversation here is more about what value proposition we brought to the transaction. So if there's anything to add there.
Yes, the only thing that I would add to Jeremy's comments is that both Duke and the Florida Commission insisted upon MWB representation, and they insisted upon that for a number of reasons. One of those reasons was, as Jeremy commented on, was to have as wide and thorough distribution effort as possible, and our firms do bring in incremental and kind of smaller investors. Another was for relationship reasons, for work that we've done with Duke over many years, and also the kind of conversations we were having with the Florida Commission about getting them to understand what the value proposition is of having our firms involved. And the other was to have a demographic representation of who in Florida are the ratepayers and how we might be able to appeal to that demographic. So both the commission and Duke, the issuer, were very interested in having us involved in that transaction for those reasons. Duke, turning to the next page, wanted to make a very public statement about their commitment to diversity and inclusion, more so than just involving us in that transaction. And they did it by doing a transaction which has not become common, but it's become not common, but with more frequency, these kind of transactions are happening, which is a transaction where the minority firms have been involved in transactions as joint book runners. And Duke Energy wanted to make a commitment to their D&I program by doing a transaction such as that. Other issuers that have done transactions like that is Toyota Motor Credit. And Toyota Motor Credit has trademarked a transaction where they include 4 or 5 of the minority disabled veteran firms teamed up along with a large bulge bracket firm to run a transaction. And it's a way for them to make a representation about their commitment to D&I. Right, and their legal counsel as well was a minority-owned firm too.
Turning to page 9, we're going to conclude this remainder of these slides to talk about what Ray just touched upon, which is what I'll call diversity firms. That acronym with a lot of letters can be hard to pronounce, so I'll call them diversity firms. And when utilities and other issuers have used diversity firms in a lead manager or book runner role, and at the risk of insulting anyone's level of knowledge, I'll just step back and define some of these terms. We often use book runner and lead manager interchangeably, and for I think the purposes of this meeting, that's fine. And traditionally, in a utility financing or any investment grade issuer bond financing, they will have a syndicate of investment banks, and you will have book runners or lead managers at the top. And in these tombstones and these examples, you've seen maybe 4 to 6 book runners, and those book runners will share 80 to 90% of the fees, the economics, and then you can have 2 to 10 co-managers under that, and they would share the remaining 10 to 20%. So you can see there's a tremendous financial disparity serving as a co-manager where you may earn 1% of the fees, and a book runner where you could earn 20% of the fees or more. So just to sort of lay out the motivations and the syndicate, and that's how the utilities think of it as well when they're assigning these roles and allocating fees to their favored banks or their investment banks who are pursuing that business. They realize that those book runner mandates are very valuable. And these slides are in here that we're going to discuss. Not that we expect to be book runner every transaction. I know for my firm, the Williams Capital Group, it's we serve as a book runner maybe 1 to 5% of the total transactions, but those are very meaningful to a small firm. And I'd imagine for the other firms represented, it's about the same ratio. But the point of these slides is to show that when we are selected to serve as a book runner, we can do a job and meet or exceed the expectations. So on page 9, we have some of the bullet points of the case for selecting our firms as a lead manager. And the first is that there is the expectation of absolutely no degradation in performance or execution by including a smaller firm, a diversity firm. They hold us to the same standards as Goldman Sachs or Bank of America, et cetera, in terms of due diligence, in terms of market intelligence, in terms of advice and guidance for strategy of what type of size or maturity or pricing to bring to market. They hold us to the same standards. And the fact that we all have gotten repeat mandates, I think, demonstrate that we do meet those expectations. As a couple of folks, including Ray, have mentioned, we do have a different investor base that we approach on these transactions. A lot of our investors are too small or just not as significant to get the attention from Bank of America, Goldman, pick a bank, where they might be the 20th or 30th call, but for our firms, they're very meaningful accounts, and they're the first call. So they value hearing from us and having the opportunity to participate where they may be small potatoes, small fries to the big guys. These are also important transactions for the issuers if they want to show their commitment to the diversity firms, whether it be racial minority, women, veterans firms. So we provide them an opportunity to really make a meaningful contribution to that sector. So there's a couple of different approaches. Ray touched on one of them, which is commonly called diversity and inclusion. Sidney and I will talk about a couple of these approaches. On page 10, the first alternative is becoming the most common, I think, and that's if you have 5 book runners at the top of the transaction, to have 4 of your large relationship credit banks and 1 diversity firm. And that diversity firm participates pari passu with the other credit banks in terms of all the things I mentioned: due diligence, documentation, guidance, advice, price discovery, sales, and then the aftermarket activities. It's the argument we used to get, and if I could the argument used to be only the biggest guys can serve those roles, but that would be the same thing as a big New York law firm coming to South Carolina and saying, you can only use a big New York or Washington law firm. Local law firms don't have the same capabilities, while local lawyers, go to the same law schools and work for the same judges and are equally as competent. They're just in a different part of the country, or choose to be in a different part of the country, and that's where we fit in. We simply choose to be at a smaller firm, and there's really no difference in any of our leadership or senior management in terms of where they went to school, et cetera. So that's what we used to compete against. Now we're being included because of the things I just mentioned. In this model of one, in fact, we can turn to page 11, a recent example of this model where you have 4 credit banks, 3 credit banks, and 1 diversity firm was in September. A couple of months ago, Williams Capital served as a joint lead manager in this $550 million 30-year financing. This is a AA utility, one of the most creditworthy utilities, so they get very good pricing. The diversity firm, Williams Capital, brought in over $150 million in bonds and orders to this transaction, so more than carrying their our pro rata amount. And this achieved very good pricing. The way investors and issuers and Wall Street looks at these transactions, you look at the spread over treasuries, in this case 107 basis points over the 30-year treasury, and how did that compare to their existing 30-year bonds, which were trading around 102. So they paid 5 extra basis points of what we call new issue concession to entice investors to to buy the bonds, and that's very low. That's a very good execution. And in recent weeks, in very difficult markets, instead of 5 basis points new issue concession, we've seen 25, 30 or more. So that's one example of this book runner model that we call Alternative 1. And I think, Sydney, would you like to take the next slide?
Sydney Dillard. So just to continue on with Alternative 1 from the construct that David Finkelstein laid out around bulge bracket money center firms working in conjunction with a diversity firm in the context of an offering. This is for an example for San Diego Gas and Electric, also in California. This deal was done in 2016, and the difference, one of the differences, this is obviously under the same holdco as Southern California Gas, but this was a 10-year transaction that was done, but a similar structure in the context of a minority firm working in conjunction with money center firms to deliver for the client in the context of this capital raising. The transaction size was $500 million. And one of the other interesting differences here is just if you look at the timeline around the transaction for the Southern California Gas deal that Williams Capital was involved in was later in the day. This was started a lot earlier in the day in the context of when the deal was announced. And then when the deal was priced in the afternoon at about 2 o'clock in the afternoon Eastern Standard Time. And so some of the specifics around what the pricing was and the size of the book in the context of how much interest was there in the transaction. So I mentioned that the size of the transaction was $500 million. The amount of interest that investors had was about $1.4 billion in interest, and that was across 100 accounts. You had some accounts that would have dropped out as you worked through that process of getting pricing to just the right place and ending up with, obviously, the book of the size of the deal at $500 million across 75 accounts. So the process along the way, is as David began to describe it in terms of the role of our firm in the context of this offering, in terms of providing market insights to the issuer, bringing in orders from investors to contribute to having interest that allows you to get the pricing to the most competitive spot to clear the market on the transaction. And then I will go to slide 12, or slide 13. Thank you. And so this is Alternative 2. We started to talk a little bit about this structure, and Ray mentioned it in his comments. And this is the specifics around this structure is where the book runners, it's flipped, where the majority of the book runners are diversity firms, and you will have one major money center bank as a book runner working as a part of the team to deliver the capital raising process for the client. And under this scenario, the minority firms will provide the guidance for the client. Generally what happens is that firms rotate through on a daily basis because you'll start this process in advance of when it is that the issuer wants to come to market. And the firms will provide a daily market update. They'll come together to share notes around how they're seeing the market and what they think that bonds would price in the market at, and provide that information to the issuer for their consideration and determination around timing given market dynamics. And so in this instance, what's happening is our firms work with all of the money center banks around transactions for clients that we share. And so this gives us an opportunity to work more closely in a senior role on a transaction. And then also the other aspect that we spoke about in terms of the economics or the fees on the transaction. Under this construct, the fees are shared evenly across those firms that are working as book runners. And so our economics in the transaction are the same. And turning to page 14, and the example here that we referenced a little earlier is the transaction that Duke Energy Ohio did. So Duke Energy's Ohio OpCo, we were involved in this transaction in June of 2016, and you can see that there were 5 minority firms that were involved as book runners. Citigroup was the bulge bracket firm that was involved here. We all had distribution responsibilities, and all of the firms delivered. Duke was extremely thrilled with this transaction. Duke Energy Ohio became the envy of all of the other Duke Energy OpCos in the context of coming out of this transaction with a 3.7% coupon on this bond. It was at the time among the lowest coupons in Duke's debt stack for a 30-year transaction. The other piece that I wanted to add is, as a follow-up to this transaction, Duke also put together an RFI that they sent out to a number of minority firms that are active and involved in the space who had been calling on them so that they could establish a better framework for how it is that they would work with those firms, better understanding their capabilities, how they could partner with Duke to deliver on the initiatives that they had around, who they wanted to work with from a capital raising perspective, and other activities, other financial services activities that the company had. And so we participated in that process along with a number of the firms that are here today and others in the marketplace. But it's become a process that we have seen other utilities employ in the context of better understanding the firms that are in the marketplace and better assessing how it is that they would establish kind of the group of firms that they wanted to work with to help them in their capital raising and financial services efforts. So that is our last example, and then Timothy Allen Simon, I will turn it over to you to provide the conclusion.
Thank you very much, Sydney, and thank you, Jeremy, Ray, and David. Takeaways here. If I were sitting on the dais right now, I'd be saying, why has Commissioner Emeritus Simon brought all this information to us? We don't run the utilities, we regulate them. We don't create the policies, the legislature does. We vote on the rates that are put forth to our ratepayers. Well, from my experience, when it came to matters like these, typically there is a staff recommendation that is given to the commissioners. Most state utility public service commissions or utility commissions are not issuers. Now, we had an exception there with the Crystal River facility where the actual commission was involved in the issue itself, and that could be something that could occur down the road with some of the stranded asset or asset securitization opportunities that are coming before this commission. But typically, there's a recommendation from the staff after their analysis because the commission doesn't typically have a financial advisor. And the expectation is, unless there's something extraordinary, that the commission goes with the staff recommendation. So in many cases, you'll find transactions that could be in the billions actually go on a consent agenda and are approved because there's no real protest or contest. Because yes, the utility needs revenue in order to run their operations, in order to maintain that reliability. So why bring this before you? We bring it before you because we have found that just your knowledge of the transaction, the fact that there is an opportunity to engage in diversity and inclusion can inspire that type of question. Are there diverse firms that will be involved in this transaction? Another point I should make, we've had testimonials from CFOs, not only in the en banc hearings that I've mentioned, actually and similar throughout the country in states like Illinois and Maryland. But the CFOs have said the ability to have an understanding from the regulators and a support of this concept sends a message to the large banks, to the Bank of Americas and the Goldman Sachs, the Wells Fargos, the JP Morgans, the Deutsche Banks. It sends the message to them that this is good for America and this is good for our state, that we should be looking in all levels of financial engagement to include as many of our businesses and citizens as we can. Utilities are extraordinary economic engines for many regions of our country, and these are the type of opportunities that the engines can create. So that is our purpose. It's just simply to raise awareness. Are we looking for some type of regulatory ruling or order? I don't necessarily think that is necessary, even though there have been occasions where states have decided to send that kind of message. But I just think the fact that we're here today and having this discussion with you, and I want to thank my other former colleague, Commissioner Swain Whitfield, for providing us a degree of guidance and direction on how to have a ex parte notice dialogue with you on this topic. But we hope that this presentation has enriched your understanding of the marketplace. And with that being said, we would gladly and would be honored to entertain any questions or concerns or comments that you may have.
Thank you, Mr. Simon. Appreciate everybody being here. This is a very informative. We'll open it for questions if anybody has a question. I had one, just you mentioned early on about regulated and unregulated. It's pretty easy to get in front of the regulated or to get recognized through NARUC people. With unregulated municipalities, that kind of thing, how do you manage to get yourself noticed?
Are you referencing the municipal and or co-op type of?
Yeah, and something or through public power, that type of thing.
Well, we have had participations. This group conducts a number of roundtables around the country. In fact, we just had one in Ohio with our esteemed colleague, Chairman Asim Haq of the Ohio Public Utility, or the Public Utility Commission of Ohio, PUCO, as it's often called. And we've also had one in Arkansas with Chairman Ted Thomas and Commissioner Kim O'Gwen, where cooperatives and public power entities have participated. I would say that my colleagues here are involved on the corporate side, but all of their firms, and you're welcome to chime in, all of their firms do have municipal or public finance functions. And more often than not, we would refer that to that side of the business. In that case, as I mentioned earlier, they are issuers. Those utilities actually, or those municipal utilities actually go into the markets themselves. And I think the one advantage that they often have from my time as a commissioner is they typically have on contract or on staff a financial advisor who goes through great lengths to explain the type of detail that you receive today. That's generally often not the case, but it's been my experience with utility regulators, because you're not running the utility, you regulate the utility. So it's a different level of detail. Did anyone want to add any comment on that? Sydney?
Sydney Dillard. Just to add a further comment on that, our firms do, through our public finance effort, as Commissioner Emeritus Simon mentioned, do work with the public-owned utilities. What generally tends to happen is within the construct of that city, that state, where the utility operates, they will, if they're inclusive in the context of the general capital raising that they're doing for that city or whatever that unit of government is, they will generally follow in the context of that in terms of how it is that they include diverse firms in their capital raising activity. So we certainly see that in certain locations around the country, certainly not everywhere, and certainly not always with co-ops, but definitely with the municipal-owned utilities. There tends to be inclusiveness that is consistent with what they're doing from an overall capital raising perspective in that city or unit of government.
Thank you.
Jeremy Traska. One thing to add that's kind of more specific to the state of South Carolina, post our 2014 transaction with SCANA, seeing that we did have a large public finance group and a high level of affinity in state, we had been recommended by some folks at SCANA. They connected us with Santee Cooper, who also had never used a diverse firm in the past. It was not necessarily in their policy. We gave them the same sort of presentation that we had with SCANA in the past in terms of price discovery, unique investors, and they included us in 2 transactions, not as a co-manager, but as selling group, where essentially the only way you can really earn any fees is to sell bonds. Because in many cases, in a co-manager role, there are fixed fees on the corporate side. So, that raised some awareness in state. Also the relationship with state treasury, but we've seen similar cases in other states where we've done some work with the IOU, the investor owned, but then because we had a public finance effort, that was the value proposition was easily translated to those issuers. And it also helped that our head of public finance was stationed at Fort Jackson for a number of years. And a couple Marines went through Parris Island.
There you go. All right. Commissioners, any other?
Mr.
Mr.
Chairman,
Williams, yes, sir.
I don't have any questions because of the quality of the presentation, so I appreciate that. I had some during the course of the presentation, but they were answered by David, so thank you for the thoroughness of the presentation. I would say that diversity and inclusion is an important matter, and in my experience, largely it goes unnoticed because presentations like this don't occur. So I appreciate the fact that you all, I think, came in from California.
I came from California, and the rest of the group, when Sydney came in from Chicago, and the rest of the group came in from New York.
So thank you for coming to visit us in the great state of South Carolina. Appreciate the presentation.
Others, Commissioner Whitfield. Excuse me.
Thank you, Mr. Chairman. I certainly, too, would echo Commissioner Williams' comments. We certainly appreciate you being here and diving into the weeds a little bit into the bond market. Since Commissioner Simon says that he's just a small-town attorney, we are certainly glad to hear from the financial experts today. I do have a couple of brief questions for you. And then I'll round it out and turn it back over to the chairman. I think, Mr. Traska, and I think I may have met you at NARUC also, but I wanted to ask, it might have been your slide, page 3, I believe it was. You were talking about diversity involvement in Dominion transactions, and you had a good slide showing that $3.9 billion of the $13.6 billion in 2016 of Dominion's capital raised, 27%, in other words, was by your group and or by diverse managers. You started by saying 2016. So my question is, prior to 2016, what was Dominion's percentage from minority diverse firms? Or I'm sorry, Ms. Dillard, that was your slide. I'm sorry.
No problem. Thank you, Sydney Dillard. Prior to 2016, we're not aware that there was involvement by minority firms. So we started with 2016 to illustrate what that work and involvement and inclusion has been in that time. And so in that time, it was 22 transactions, and so 27% of those transactions that represented the $3.9 billion in par value is the work that's been done where minority firms were included.
So you're not saying it was necessarily zero, you're just saying you had no record, and this is where you kind of documented that one particular snapshot,
Yes,
if you will.
exactly.
Okay.
We started with 2016. That's correct.
All right. Next question, I'm trying to remember who had the slide. Page 11, alternative 1, who had that slide? Okay, Mr. Finkelstein. You did a really good job laying out the timeline of a particular day, even down to the hour and minute that the deal was announced and the deal was finally priced, and you show the book runners, and you did a good job explaining that, since Commissioner Simon again says he's just a small town attorney. We certainly appreciate you getting into the weeds a little bit here, but one of the details you mentioned of the $550 billion raised, 550 million, 150 million was Williams Capital. And how do you all decide who raises how much capital, who's a book runner, who's a lead manager? How do you decide these roles, or how are those the assignment of debt or raising that amount of capital of the $550 million? How do you decide who?
Excellent question. The issuer decides in advance, and on a transaction like this would call the 4 book runners about a week in advance and say, you 4 are going to be the book runners. You're going to run the whole show jointly and equally, and you're going to get X amount of economics, might be 22.5%, 20%. So the economics from that context are set in advance by the issuer.
I see.
A different topic is, and that's why these are called fixed economics transactions. A different topic is who places the bonds. The book runners, the joint lead managers operate cooperatively, and they all individually go out and solicit orders. In every one of these case studies, we will show that a transaction, and this transaction had a total amount of orders of $1.35 billion, but we only have $550 million in bonds we can give these investors. So there's an allocation process where those 4 book runners, the syndicate representatives, either electronically or get on the phone, and they negotiate internally who should get what. This account should get this amount. This account should get less. And that process is called the allocation process. But so if we place $150 million, doesn't mean we're going to get paid on the economics and the fees were set in advance. But that's just a measure of where the bonds ultimately go. But again, it's a cooperative process among the book runners in terms of which accounts get what. Does that answer your question?
Right. Sounds like it's ultimately up to the issuer, but you do have a lead person or someone in charge, if you will.
It's up to the issuer to allocate the
fees.
But in terms of the actual bonds and where they go, that's not. The issuer is not involved in that generally. They defer to the investment banks.
I see.
Sidney Dillard wanted to add to David's comment to talk a little bit more about how the issuer actually decides on the fees, and there are a number of factors that come into play there. One is the banks that they work with who may be supporting them from a credit perspective, providing their balance sheet. That goes into consideration around those firms that they will select to be in lead roles with their firms. Other considerations will include those banks. There's trust. We started the beginning of this presentation talking about that, and those firms that they trust will actually be able to deliver for them in the context of a transaction the things that David referred to in terms of bringing investors to the table. The more investors you have at the table, the more price tension that you have, the better pricing on a transaction. So they want to make sure that a firm can deliver in the context of that for them as well. Firms that are clearly in front of them and providing advice along the way that they feel can deliver for them in the context of a transaction are things that factor into who they select in the book runner roles, and then how much they get allocated in terms of fees.
Well, thank you.
Commissioner Whitfield, if I could just, I know you're trying to move on to another question, but if I could just add a little more to that. And I think this is critically important in understanding how firms are selected. And I was a securities attorney for many, many years. The issuers are either go to market under or their engagement with the banks here is either under what's called a firm commitment or best efforts. And this relates specifically to the balance sheets that Ms. Dillard had referenced. The vast majority of issues that come out of investor-owned utilities, most of which are in your Fortune 1000, are oversubscribed and generally best efforts. So that balance sheet or capability that the credit bank has is really more to do with their lending as opposed to their underwriting. And they're making that available to the utility, which provides them a degree of liquidity. Mm-hmm. However, it's not necessary for the transaction that's coming before your docket. And I think that's important to emphasize, that the firms represented here today have what we call in SEC parlance the net capital capabilities to underwrite these issues, of which most are, and I'll ask my bankers to correct me if I'm wrong, which most are oversubscribed. So there is a minimal degree of risk that's involved in the transaction. And that's important to emphasize. And, referencing back to what I'd mentioned earlier about the CFOs, the chief financial officers have said that it really helps us when we have a new class of creditors or investors that are holding our paper, rather than that paper just going to the top elite institutional, pension type investors. So these are real value adds that come out of this process. Thank you.
Right, and I seem to glean that your last line from your presenters. But lastly, I would ask you, in the Florida case, were you familiar with if Florida had a securitization law on their books when you went through the Crystal River raising capital for that? They did?
Yes, they did have a securitization, and ironically, in California, we recently had the legislature authorize a securitization of, in this case, of third-party claims involving the tragic wildfires. So there is precedent, I believe, around the country. Some commissions have that rulemaking quasi-legislative capabilities. Others have relied upon their state legislatures to provide the authorizations. But in either cases, those ratepayers are sacred. So anything that's touching the ratepayers, as you know, has to come through that Public Service or Public Utilities Commission.
Well, I would certainly thank you for your presentation, and thank you for being here. And you might want to possibly do a presentation to to members of our legislature or the PERC committee. We are certainly not policymakers here at the commission and the way our laws are set up in South Carolina. And certainly thank you for all of you for your informative presentation. That's all I have, Mr. Chairman.
Thank you. Commissioner Hamilton.
Thank you, Mr. Chairman. Commissioner Simon, it's always good to see you, and like you got some talented people with you, and we appreciate your presentation. It kind of helped us move up a little bit as an educational process. I don't know if that's what your intentions were, but you certainly did it. My question is, how do you get to the table? I know in local government, diverse groups always had an edge on any federal or state grants, that they were given an extra points in deciding who won the grant and what was offered in their bid. Do you have any such option? Do you have any endorsement or anything from state or federal government that would give you an edge on being able to get at the table? It's just on your talent and your expertise?
This is free market capitalism where we've got to compete against the big guys on our own merits. Our ownership might get us a foot in the door and a meeting, but no, there's no extra legislative requirement or bonus points awarded to us.
As I had mentioned earlier, some states have a process that provides incentive-based or merit-based goals. That would be California, Maryland, I believe Illinois, New Jersey. But for the most part, as Mr. Finkelstein stated, it really takes efforts on the part of these very talented companies to get out and tell their stories to the regulators, to the legislators, to the marketplace. Now, what you will find is that most of your utilities do have supplier diversity programs in place that are designed to open up that spend to diverse businesses. It has been a challenge in the professional services area. Historically, it's been in areas like construction, catering, maintenance services. So to raise that awareness that utilities can actively engage on the professional side, like investment banking, has taken efforts like we're doing now and we've done around the country. And thank you, Commissioner Whitfield, for that recommendation, and we will look at making presentations to the legislature as well.
Yeah, I think that'd be wise. We appreciate you being here. Enjoyed it very much.
Thank you.
Thank you, Mr.
Thank you. All right. We appreciate you folks being here today. It's very informative. Come back anytime. We are adjourned.